I'm happy to be here. I've already been here once before for some other function. At that time, I met the principal and she said, "We'll have you back." I think I was only an MLA then, maybe. Or had I become minister? I'm not sure. MLA. And so, when I got the invitation today, I must admit the last few days have been very hectic because we've had a lot of government programs. Even today I have 3 or 4 events. There's the global NRI meet, Tamil meet being run by the government. I have to go speak at that. So had I known that this was coming the same day, I might have hesitated. But at the time I didn't know. And even if I had, I would have come for 2 reasons. One, I think, a good politician or a good policy maker should match their actions, their priorities, their budget allocations, their department functions to their stated philosophy of why they practice politics and why they want to get somebody's vote. In that sense, every day, in every way, whichever portfolio I was, whether I was MLA, opposition, government, I tried to be consistent that I prioritize what I say is important for society, and what is very important for society is education, and education for all, starting with ensuring that the 50% of our population, that is women, get equal access to education, to inheritance, to jobs, to opportunities. So in that sense, to come to a women's college is important to me, and I would have prioritized that probably anyway. The second thing is that the topic is about finance, which, as the principal said, it is a vital topic for most of us. In a minute, I'll tell you how I found out that it's so important and how I ended up with a career in finance. But let me first acknowledge the gracious presence here and the introductory remarks of the principal, Dr. Lillian Jasper, the driving force of the department, and I'm sure this seminar, Dr. Elizabeth, Dr. Kalpana Naidu, who has been kind enough to give me a generous introduction, Dr. Ethan Muller, who's going to deliver the vote of thanks, and all of you. But finance, I think, is so vital, and I learned the hard way. And I thought when I got this invitation, I met the team that's organizing, or some members of the team that's organizing this conference twice before today. And they were telling me about all the sophisticated topics about AI and the innovations and things like that. I left the world of banking and finance almost 10 years ago. I think almost 10 years ago. And so I thought, technology evolves, the markets evolve. Of course, I observe it from a distance. Of course, I have a couple of decades of experience, so I can assimilate. But at some level, it should start with the basics, and it should always be a context setting and a framework development that I hope can add value. So in that sense, I have no prepared remarks today. I wrote up some things in the car on my way over, and I'm just going to talk about those. I hope it'll be of some value. I've been told by ANSI that I have a strict limit, no more than 30 minutes. That's okay. I also have other appointments to go to. I'll try to talk for maybe 20 minutes. But let me start from the beginning. I actually got into the world of economics and finance very late in my life. Much like the principal said, when I was an engineer and then I got 2 other graduate degrees in 2 other subjects, I never really thought about the world of economics or finance as being vital to anything. I knew how to do my job. I ran a consulting practice. It was very successful. In the US, I got my green card within like 3 days of finishing my PhD and applying. So I thought, I must be good at what I do, and what I do must be adding value to society. Why do I need to learn anything more than this? I was fine. But then I started going out to clients, and I started realizing that no matter how good the project, no matter how clear the engineering or the design or the human element in some proposal, everything would get us stuck at finance. Sometimes they'd say yes to things we didn't think were going to come through. Sometimes they'd say no to things we thought were no-brainers. And I started realizing there's this whole world out there that I know nothing about. 3 degrees and 3 majors later, there's some part of the world that's a black box to me. I have to figure out what to do. And so at the ripe age of 33, I went back to business school for my 4th degree in my 4th major. And I had the great luxury of going relatively late in life, where I'd already learned a lot about how the world works, and of going to a very good school where there's a lot of Nobel laureates. Probably University of Chicago and MIT Sloan have the 2 highest number of Nobel laureates in economics. And got to learn from very deep thinkers at an age when I had the maturity to understand what they were telling me. And so I ended up having a very successful student career, and then subsequently very interesting and wide-ranging career in finance. But it started probably with a professor that was by then nearing the end of his life. He had retired. He was an emeritus professor, a Nobel laureate called Franco Modigliani, who had taught at MIT for decades. And one of his profound theories is called the life cycle theory of consumption. It's pretty widely available on the internet if you go look it up. But it laid the foundation for the whole notion of the world of finance, what we call the BFSI sector, why it exists, what is the role of intermediaries, why should there be the need for a bank, why should there be the need for capital markets, what should be the role of the government in providing social security, savings, schemes like the NSS, National Savings Scheme, etc. And it really talks about how if there is relatively stable consumption across a lifetime, then almost everybody is going to need to move money either forwards or backwards in time. Most of us will need the financial support of somebody, including in your current stage of life. At some point you'll start earning, and then you'll probably start, if you're smart, saving some of what you earn. What are you saving for? For future expenses, for your retirement, because you won't work till you die. At some point you'll stop working. You'll still need to have some consumption. So it's a very simple theory, but it talks about the profound reason why money needs to be moved back and forward in time, and why the whole industry exists to intermediate this movement. So really, you started with banks in the old days because they were considered trustworthy institutions, and they could be cross-verified through ratings, through other kind of regulatory mechanisms. And then you started seeing the evolution of financial markets, where you didn't need a bank, but basically the raisers of capital and the investors of savings could come together. But in that sense, the evolution of the world of banking and finance, probably the first seminal event was the Great Depression and the market crash that preceded it in the 1820s, 1828, 29, something like that. Till then, the nature of regulation, the nature of standards, the need for a level playing field, the need for having transparency in markets that would allow investors to have some faith that they were not going into a casino where the odds were rigged against them, probably had not been explicitly stated or built into legislation. The first legislative acts really of that scale came in the US, 1935-36, the regulations that created, among other things, the Securities Exchange Commission and so forth. So the world of finance, I think, started in a different trajectory than it had been in the past, where it was relatively unorganized and it was relatively cutthroat with no protection for individuals. And over time, it has evolved to the state it is now. Now, what you're going to be talking about today is what is the advent of technologies like blockchain or artificial intelligence, and the great leaps in data capabilities. What is that going to do to this world? But I thought I'd just touch on maybe 5 or 6 things that I've learned, because once I finished graduate school, I had the great luxury of a career deep in the heart of Wall Street in what was then the hottest area of Wall Street or the markets. It was called credit derivatives. So we had just seen the evolution of credit default swaps, then eventually securitized versions of those called CDOs, synthetic versions of that because it was all swaps that were then securitized instead of actual bonds. And the whole evolution of high complexity financial engineering and math modeling was the first exposure of my career. And I spent probably 7 or 8 years in the heart of that machine on Wall Street in New York, and to some extent in London and Hong Kong, where the secondary evolutions were happening. And then for various reasons, I came back to India and I set up what became, at least to my knowledge till now, the most advanced, what we call GCC, or Global Capability Center in the world of banking and finance, where out of this place I hired, I think in 2 years, 83 graduates from the IITs and IIMs, and altogether about 200 employees. And we ran all the most complex mathematical aspects of a Wall Street trading bank: synthetic securities, risk management, exotic volatility, residual credit risk, securitization, and intellectual work like basic research and strategy, printed in the names of graduates of India, but published in New York or Europe, covering European securities or American securities. And then the global financial crisis happened, and I went through the crisis as the head of 2 companies that Lehman Brothers had in Bombay. And after those got resolved, I got paid to walk away. I took the package, I retired, I thought. And then all the capital in the world that the financial system was pumping out ended up coming to the Middle and Far East. And so investment banking here picked up dramatically. And I went back for a second career at Standard Chartered Bank and saw trillions of dollars, maybe $3 to $4 trillion from the OECD banks that were printing money like it was going out of style, appear in Africa, the Middle East, in Asia, and transform our markets significantly. Then, of course, I left the world of banking, took early retirement to enter public life, and I ended up first as an opposition MLA, sitting and reading audit reports and going through the Public Accounts Committee membership for 5 years, through which I learned a lot. And then the second term around as a sitting Minister for Finance, and also now for Minister for IT after 2 years. So in that sense, I have a probably unique perspective of the evolution of the world of finance, certainly in the last 25, 30 years. And if I stretch my learning back, probably going back to a century or so. And I'd like to touch on maybe 4 or 5 aspects of the world of finance that I think A, are very important, and B, are transforming or going to be transformed with the evolution of all these new technologies. And it starts with the basics. I think one of the greatest areas of sophistication in the world of finance is actually accounting. I don't know how many of you are accounting majors, but if you look around the evolution of accounting standards, what we call FASB, the Federal Accounting Standards Board, IASB, International Accounting Standards Board, or here what the ICAI does, which is again bring in some regulation, the interpretation of what is a retained interest, the interpretation of what is a subsidiary that should be integrated into the consolidated balance sheet, the interpretation of which risk is considered off balance sheet, which is on balance sheet, which can be accounted for as held to maturity, which can be accounted for as available for sale, which can be accounted for as a trading asset and therefore has to be marked to market daily. These kinds of definitions and the changing role of these definitions actually drives a lot of the valuation of securities in public and private markets. So the world of accounting has actually evolved dramatically. And I would say one great contribution to the global financial crisis was the arbitrage in accounting standards. That is something that the US accounting standard would call one way. The European accounting standard would classify it a different way. And there would be some financial benefit to having it classified B versus A. And that led to a lot of risk transfer. In fact, if you ask yourself, why was the global financial crisis a global crisis and not an American crisis? Because almost 90% of all the assets that were overvalued and brought back to reality, or 95% of them, were US-based assets. It's not like mortgages in India ended up going overvalued or underwater. It was all US assets. So why was a big US asset bubble made into a global financial crisis? Certainly one big part of that is the variability in accounting rules and accounting treatment across the world. I would urge you to look at 2 or 3 major trends as you think about careers in the financial markets or in banks. One is globalization. Despite the recent pullback after 2008, after the GFC, it is still a hugely global market. Trillions of dollars of capital flow back and forth, and will greatly swing markets. If you look at the Indian stock market, for example, the total valuation of the Indian stock market is relatively so low in dollar terms that a small change in the sentiment towards India of global investors will dramatically alter the valuation of the Sensex, and there will be no other driver of it. Simple sentiment, how many billions of dollars get pulled. Compared to the US market, will be a fraction, 3%, 5%. But if a couple of big asset managers were to change their minds, you will find the markets move dramatically. So globalization would be one. The second is derivatization or securitization, the extent to which you can trade risk without having an underlying, what we call a real money security, a bond or a stock, but actually call options, put options, default swaps, aggregations of these into instruments like a collateralized mortgage obligation or a debt obligation or a synthetic equity swap, which has a lot of complexity in it. Risk gets traded in ways that most people do not actually understand. Neither the buyers nor even the sellers in some cases really understand what they're selling. That's what the GFC taught us. And probably the biggest villains in all of this are the so-called rating agencies, the S&Ps, the Fitches, who I once had the luxury of sitting when I was in Stanchart next to Larry Summers, the former US Treasury Secretary, and he called them the most uninformed, least courageous participants in the market, right? Because they basically act retrospectively after something fails, and they're very reluctant to be leader to say this is not really what it's supposed to be. So derivatization, securitization, globalization, and accounting standards. And I think these are areas which will greatly determine the flow of funds and the nature of risk and the evolution of the markets. And these are all areas that I think you can have great careers if you specialize in them. Another place where I think the markets have evolved a lot is infrastructure. If you really think about how risk is moved around the world, the amount of technology in it is just amazing. If you take a large bank like Lehman Brothers or like Morgan Stanley or Merrill Lynch, now in Bank of America, the amount of technology required to run the trading platforms is so high that all buildings are now built in what they call a wedding cake design. That is, that the lower floors will be wider because they have to bear more weight, and then the upper floors will be narrower. So if the FSI is X, they'll put more width in the lower floors, and all the trading operations will be here, and then all the offices and the bankers and all that will sit in the higher floors, which is just offices. Why is that so? Because to run a trading floor, a over the counter, over the phone, no big board, no shouting trading floor, requires so much technology and so much wiring and so many computers. When I was a trader, I had probably 6 screens in front of me. At that time, the biggest screens were 18 or 20-inch screens. Had like very high-powered computer. Had a bank that had probably 30 phone lines in it and 6 PA lines, public address lines that I could speak out of, or it could come through my phone, what they call turret. It was like a computer in itself. Every desk had one of those, and there would be 4 desks on this table. So the average trading floor had so much extra weight and needed so much extra air conditioning to make sure that the computers didn't overheat, that actually you needed to have a broader base just to have that much technology and infrastructure in it. If I hit something on my screen, I get a call, they say, where will you offer this? I say something, they say, I accept, the trade is done. Incidentally, in states like New York, all those are recorded lines. And if I say I accept on the phone, that is a defining, legally binding conclusion of the transaction. That's it. Doesn't need a written document, doesn't need all those will follow secondary. But the phones are recorded. When I say, you're done on that, or I agree, I sell or I buy, that's the transaction is done. That's the beginning of a process. After that, the number of steps that it will take to actually deliver the security and receive the cash sometimes will take 2 days, 3 days, 5 days. All these securities have what's called a settlement format. T+1, T+2, T+3. Foreign exchange has a different one. Commodities have a different one. Bonds are usually T+3. Derivatives almost every day. And then a whole process which will take 8 to 24 hours will happen, in which middle office, back office, all of these guys will square up the accounts, deliver the securities, find the securities if you've sold them without having them. They'd have to borrow and then finance them and sell them. If you've sold something or you bought something and you don't need to hold it overnight, then they'll put it into repo facility. So there's like a whole machine of infrastructure that happens. For every trade, there's probably a few hours of work. What takes 10 seconds on the phone to say yes or no. And all of those steps are changing dramatically because of the evolution or the advancements of technology, as well as of the onset of AI. I see that one of you is from StanChart, right? Yeah. So in StanChart, when I was managing director, senior managing director, we used to have hundreds of people, I don't know if they're still there, whose job it was to just get the output of the computer, the high-powered computer that would have analyzed all the reported suspicious transactions that day and see whether it was worth forwarding to the authorities, right? This is basically anti-money laundering and prevention of money laundering activities. A good friend of mine is a very senior officer, one of the biggest custody banks in the world. They have about $30 trillion of assets under custody. And he was saying they have about 400 people in Chennai doing that work. And the way the AI has progressed now, that last stage where the computer's output, after having filtered hundreds of thousands of transactions, still requires a human brain to look at and decide has it met the threshold or not. Now the machine, the AI, can actually do that work as well in short order. And so the entire nature of that job will disappear, at least as a human job. So there's a whole lot of infrastructure evolution and AI-based transformation. Technology is changing a lot as well. For those of you who are enthusiasts of the equity markets, of the share markets, an old boss of mine on Wall Street once told me, when I left fixed income and went to equities, I didn't realize I'd left the finance business and entered into the technology business, because a lot of equities are transacted through exchanges, or now what they call dark pools, and they are based on a computer reacting to another computer. So the computer that is the dealer's or the broker's computer, and then the buyers or sellers in the back end, they see each other. And when they see each other, makes such a big difference that if you look in Mumbai even, this was true in New York even 5 years ago, but today in Mumbai, the ability to locate your server, that is your computer server through which your transactions are happening, 500 meters or 1 kilometer closer to the Bombay Stock Exchange's computers actually demands a premium in rent. Think about that. Think about the speed at which electrons travel on a wire or light travels on a fiber optic cable for the information to pass from place A to place B. And yet, it is actually an advantage to be 500 meters closer to the server because your order will get hit first. That nanosecond, that millisecond is making a difference. That's how much technology and communication speed have impacted the market. A lot of things are going to change as a result of compliance. Now, compliance by definition, regulation and compliance. I should say regulation first, because compliance is to regulation. Regulation in most parts of the world is always retrospective. The markets evolve faster than regulators can predict, or faster than regulators can create new guidelines. and it's usually regulations playing catch up. As I said, there's arbitrage also on when the regulations reach which place. But regulation is a double-edged sword. My good friend Raghuram Rajan, who is on the board of advisors, a panel of advisors to the government of Tamil Nadu, was once asked when he was RBI governor. He said, he was asked, considering that Indian banks were not affected so badly by the global financial crisis compared to foreign banks, would you say that we have done a much better job of regulation of banks? And his answer was more nuanced, mine will be more blunt, but his answer was, it's hard for me to say that because the regulation was so far behind the efficient frontier that the fact that you never had a crash as good as it was may be offset by the fact that you were so inefficient in your regulatory frontier. Or put another way, he said, it's hard for me to congratulate somebody for crossing for not having been hit by a bus while crossing the road. That's what really you're saying. If you do advanced regulation, it's like running across the street where there's traffic, and the bad outcome is that you may get hit by a bus. The good outcome is you'll be on the other side. He said, it's hard for me to congratulate somebody for not getting hit by a bus if they never crossed the street in the first place. So if you didn't even start regulating towards efficiency, then the fact that you were protected from the bad outcomes of efficiency is hardly congratulatory. I said it another way when I spoke at CII a bit later. I said, the average borrowing cost relative to the country's credit rating or the government's debt, so we call that the credit spread. How much more does a company have to pay compared to that country's government having to pay? If the average credit spread in an efficient market was 2 percentage points lower than the credit spread in India, then I asked the question, if you get 30 years of 2% lower interest rate, and the price of that is once in 30 years, you're going to have a global financial crisis or a country financial crisis that's going to knock 20% or 10% off the top of your total economy. Mathematically, that's actually much better than having a 2% higher interest rate for the next 30 years, and therefore a lot of businesses that were in that 2% margin of profit will never get funded because the cost of money is too high. We are a country like that where the cost of money is too high. So regulation is a double-edged sword. If you allow innovation, if you allow that efficient frontier to be touched, the odds are at different times you're going to find it breached. But if you never allow it, and particularly if you're very conservative, you will never have a bad crisis, but you'll have 30 years of stagnation or subpar growth. That's something to think about. Central banks, the role of them has changed pretty dramatically. I don't want to say something about the Indian central bank because it might be considered political. So I'll talk more about the role of OECD or advanced country central banks. And I will say that central bankers have become like politicians. They're more worried in their image and they're more worried about their standing than they are about doing what is right, even though it may be unpopular. We still live in an age of unprecedented liquidity. In the global financial crisis aftermath, about $5 to $6 trillion of excess liquidity was printed. When the pandemic struck, that was further increased. And so right now, if you look above what would have been the natural growth of money in the system, we're probably sitting on $5 to $6 trillion of excess liquidity in the system globally. Some of that has seeped into India. Most of it is in other parts of the world. But every market is highly valued because the money has to go somewhere. If you look at the PE ratios, if you look at the market valuations of these companies, they are all relative to historical standards hugely overvalued, hugely. But the money is out there and the central banks are now stuck because were they to start taking the money back, they would have to release all the government bonds and all the massive debt that governments racked up that is being held in these central banks as if they were equivalent of gold. And were that to come into the market, it could really damage the whole market if there's an excess of treasury supply. So at some level, we are living in a world where the perception of normalcy seems to be continuing for longer than I thought it would. And we are certainly in unprecedented waters, at least relative to the last 120 years or 110 years, in terms of the stability of the system in terms of the relative supply of money, the relative balance sheets of central banks, and the relative valuation of assets. I'll close because I'm reaching my time by saying that as many of these technical and framework and basic concepts that I've talked about, at the end of the day, much like anything else, it's human nature that drives a lot of outcomes. So if you're on the street, you learn very quickly what to do when and what not to do when. When is the market liquid and deep? When is it thin and not to be done unless you need emergency transactions? And the perception and timing of things is very different. If you're a private equity manager or buying real estate assets, your time frame is 10 or 15 years. Most people would have changed jobs 2 or 3 times in those 10 or 15 years. They're not going to be held accountable, so they can take reasonable risk, and they will. Usually it turns out right, sometimes it turns out wrong, but by then you would have changed 2 jobs. If you're in the money markets, every day your assets are going to get marked to market. Then you have a different nature. Most people are not 100% owners of their assets. They're actually working for a company or an asset manager. And lastly, I would say, if one of the lessons we learned from the global financial crisis is that institutions that are too big to fail. What does too big to fail mean? They are so important a component of the system that were this institution to fail, typically we say that about banks because it has the savings of average citizens, then the entire economy and the whole socio-political construct would get damaged. So one of the lessons allegedly that came out of the global financial crisis was that we must not allow too many institutions to be so big that they can fail, or if there are some that we can never curtail, then we must impose extra regulations on them, extra capital constraints, extra reporting requirements, extra viability checks or balance sheet guidelines and frameworks. In fact, if you look around the world, that has not happened. We still have too many institutions that are too big to fail with too little oversight and control. And if anything, on the asset management side, which is now the Vanguards, BlackRocks of the world, in the liquid markets as well as the illiquid markets like venture capital, private equity, we have become a kind of oligopolistic market where a few institutions are controlling trillions. I'm not talking about billions, I'm talking about trillions of dollars. Just give you one example. The biggest asset manager in the world, BlackRock, when I was a banker on Wall Street, let's say in 2005, the total assets under management were about $400 billion. Today, that number is north of $5 trillion. So they've gone up more than 10 times. So imagine, they're so big that they are the first or second or third largest shareholder of almost every listed stock in the entire world. One asset manager, one company, one CEO, one chairman, one head of risk management, so forth, managing that kind of money, and no human being is infallible. So if anything, this concentration risk of institutions that are too big to fail has changed quite dramatically in the wrong direction if you look at the intermediation space as a whole. Even the banks are not better regulated, and now the asset managers are much, much more concentrated. So with that, I would say I'm not nearly well equipped to talk about the most recent advances in any particular slice or sector of the industry because it's been a long time. You have eminent speakers here who are going to talk from first-hand experience of doing this on a daily basis. But I thought I would use this opportunity to give you a broader picture and lay the kind of framework of thinking about finance, about the risks, about the possibilities, about the future that I only learned when I was between 33 and 35 and then upwards from there. So since you're all very young, I thought maybe it'd be of some value to you to get this broader perspective. Thank you very much. I'm just about getting out of time. I hope you have a good, full conference. Thanks.